Please be advised that the information presented herein is for educational purposes only. It is strongly recommended that listeners should seek guidance from qualified paid professionals of their choosing before acting upon any information or materials discussed. Hey everyone, welcome again to another edition of Real Estate News Unpacked. I'm your co-host Marcel, your mortgage money guy, alongside Ronald, your 5-star Michelin design, all things multiplex design. We've got a lot to talk about. There's some exciting updates this week. Toronto Sixplex DC Unlock. It's game on for Sixplexes in Toronto. This is what we talked about, a while back, Ronald. We've got the Toronto DC money bag, which Ronald's going to take us through. He's following that $4 billion fund there, with that federal fund that's coming through. What is that fund called, Ron?
That's the Housing Accelerator Fund.
The Housing Accelerator Fund. We've got some permeable paver parking unlocks. So this is design oriented. This is going to help unlock parking, especially outside of that downtown main corridor in Toronto. We've got recessionary fares that are coming up. Is Canada going into a recession? Everyone's concerned there. And last but not least, we've got our updates on mortgages. So fixed rates are on their way up. And what will be next for borrowers? All this on this edition of Real Estate News Unpacked. Let's jump into it.
Yeah, awesome. Well, as Marcel just mentioned, there's been a ton load happening in the city of Toronto. And I do want to just point out here, Marcel, as you already aware, there is a lot of progressive housing policies that are coming through in every city. But I gotta say,
Yes.
Toronto is leading the way.
Toronto is making me very proud right now. Making me very proud of pushing this forward. What do we got here, Ron?
Yeah, so basically what it is I got up on the screen right now is essentially a map that outlines all of the 25 wards in Toronto. So for those of you who don't know, there are 25 wards and there are 25 councillors. While I don't know the name of all of them, I will say you can see that there is a portion of this map that is basically highlighted in orange, right? So that portion of the map is essentially the most populous part of Toronto, right? And I believe you also, this is where you work and you reside, and this is your part. This is your neck of the woods, right, Marcel?
Yeah, this is my neck of the woods. Yeah. So this is center ice, what we call center ice. If you're in London, you'd call that zone 1, zone 2. So the closest you are possibly to the center of the universe.
That's right. That's right.
Is what we believe.
Exactly. So here, yeah. So this is the center of the universe. This is the center of Toronto. Here's where all the money is made. This is where everything happens. And in fact, for those who may not know, this is, I think you got like 8, 9, 10, 11, 12, 13, 14, 19. These are the wards that are in here, in this little pocket, is the most popular. So what's really interesting that I want to note is the city of Toronto on the last council meeting on June the 25th actually expanded the pilot project for sixplexes within this central core. This center of the universe, as you just referred it, right? And this is just how policies play out, right? What happened is there's been a new overlay of policies that came through just yesterday, which was the 24th of July. City Council met and they adopted a motion essentially to allow permeable pavers for parking, right?
Permeable pavers for parking.
That's right.
What does that mean? Why does that matter?
What the bylaw allowed before was that you had to have a certain amount of your front yard, your rear yard, your entire site allocated for parking, depending on the development. So, as many know, parking requirement in the city of Toronto is essentially waived or based on market requirement. So it's discretionary, right? So you're not required to have parking, but you need to provide parking based on your tenant profile, based on the buyer's profile, right?
And I guess transit would play a big role in that as well, right? How close you are to transit and whether or not your site can be done without parking.
Yeah, that's right. So if you're in a TOC, I guess you're the transit-oriented community, it doesn't necessarily apply to smaller scale missing middle projects, which I'm talking about here is like 2 to 10 units, let's say.
Right.
Right? But nonetheless, if you're within a 200-meter radius of a subway station, you're actually, or mass transit, right? Whatever, so they call it a protected mass transit station area. If you're within 200 meters of that area, then you are allowed to waive parking in most other cities, but Toronto, you would be allowed to do slightly more density, or you may have a little more leverage if you're going to do a zoning bylaw amendment or so forth, right?
Okay.
But again, what has really happened here is that parking is discretionary across the board, right? In Toronto, based on the discretion of the developer and of course the market needs. So what has actually happened now is that you are allowed to place parking on a discretionary basis. So having the ability to use permeable pavers remove the requirement of this like landscape requirement that you must have, because you couldn't park on greenscaping or softscaping.
Right. So this is a major unlock for the design of your multiplex or your new home or whatever it is, your retrofit, your reno. This is a design related unlock. This is a massive value related unlock, because now where you wouldn't have been able to have parking, i.e. green landscape space, what they're saying is now you can use these permeable pavers, and that space can now, a portion of that space can now be unlocked for parking. Right?
Yeah. And maybe I should be careful in saying pavers. I know there's a permeable product, right?
Okay.
That is approved for the load of a vehicle, right?
Okay.
So it's two purpose.
So Ron, is this like there's going to be like a list of products, and then you can kind of choose from these products here, on the city's site or something like that, and those are the ones that you can use. So it's kind of choose your own adventure kind of thing, and away you go. Is that what it is? Okay.
That is really good. So in fact, that is actually what I suspect the city is going to develop. I believe there are already some innovators in this space already. I think there's a permeable asphalt product that you can look up. We can probably look it up and maybe put a link in the description.
Yeah, I've seen a few products. I know like there's a one that kind of looks like a stone or like almost smooth kind of stone, and they put it on, and that's actually permeable, right? So you have a driveway now, and the water can go through, right?
Exactly.
So I've seen a few of those products, and I remember seeing some of those guys at the trade shows, and they were super busy, right? Like they were like super busy with their installs. So it seems to be absolutely. This is good. This is really good. It's good for the industry. Maybe there'll be more innovation, more products that come onto the market, better looking products, right? That kind of have some good aesthetic as well. So yeah, this is good news. I like this. This is good news.
No, and again, the area that's highlighted in orange is the area with the most density where sixplexes are allowed, but it does not allow for the permeable unlock. All right, so just want to be extremely clear. This is the area that does not allow for that permeable unlock.
Okay, so just to be clear, we're saying the center of the universe, these wards that are outlined in orange, have not been unlocked with the permeable the permeable solution, the permeable parking solution. Exactly. It's the other wards that are outlined in blue that have been unlocked.
That's right. So those areas.
So we're waiting. So we're waiting on center ice to be unlocked, because once again, that is where it will be needed the most, because that is where the majority of your multiplexes are, by virtue of the product, by virtue of the density, by virtue of where transportation is current.
I'll say to that point, I think that's the reason why there's a few reasons, a thought pattern behind why these areas are not unlocked. And I think one of the major is that this is where the most floodings occur, right? So the most floods occur in this area. And you may or may not know, but one of the factors that contribute to flooding is, of course, the water runoff or the overwhelm of the stormwater system, right? So this is why having this permeability on site is extremely important. What they're doing, they're just simply saying, well, on the outskirts of this center ice, is like, we are going to allow you to do this, how simply because we don't have as much density, which is the second point. Because there is so much density, there is more hard surfaces versus the suburbs or the outskirts of this area. So with more hard surfaces, it means water is quickly running off these buildings and running and trying to find an outlet, which is in the stormwater system, right?
Right. Yeah. It's funny because we talked about this while we were doing our on-site educational.
Yeah.
And I brought up the point. I was talking to some architects that were on site and some newbies.
Yeah.
I brought up the point of my disdain for sump pumps and the way they're used. Essentially, they pump the water out, and the water essentially just comes back in, and it's just like this permanent kind of thing on rotation. And I just think that innovation needs to be like re-examined and looked at, because like sooner or later the sump pump's going to go down because it's just working 24/7. So now you're gonna have to replace it. So not that I want to dive into anything, but I digress on that. But just kind of bringing up a point around water management, right?
No, water management is core to a city operation, and here's one of the challenges that these cities are encountering is like they're trying to balance between having the necessary infrastructure. And by the way, if we start seeing like hundreds, I mean, right now, yeah, there are dozens, but once we start seeing scores, even hundreds of these being installed, and entire streets are filled with sixplexes, almost certainly guaranteed that there is going to have to be some solution, some additional solution for stormwater management, for sewer management, for water line upgrades. And I'm talking from an infrastructure standpoint, not to mention, of course.
And also hydro as well.
And as well as hydro, exactly. Yeah. And I'll just drop a caveat in there as well and say parking. Maybe they might have to start to do some elevated parking structures where it is you're allowed to park there. And, because most people that live, like sometimes people live in the city, but they work in the suburbs and vice versa, right? So,
right. Good point. So yeah, this is definitely something bigger picture to think about. And most of us don't think about infrastructure. That's always got to be in the back of our mind. And I think, as these things, start to come on board and we start to resemble, more of a, New York City, kind of London, these Hong Kong, like these highly dense populated cities. These are things that we have to think about.
No, that's amazing.
No, thanks. Yeah, that's good. That's great.
Awesome. So again, just kind of going back to this whole idea here, why is this important? So these unlocks are extremely important for the development of missing middle housing. So the Toronto Municipal Code actually is what dictates how the city basically functions as far as collecting money, operation of various aspects of the city, and it's all documented in here. But this specific area that we're looking at is specifically talking about the exemptions on what is called parkland dedication. So for those who don't know, parkland dedication is essentially every development need to allocate some type of land for public realm, right? And this is something that you may say, well, I have done a number of developments. You are a developer, right, Marcel? You're a city builder and you have done a number of projects. Have you ever had to like put a portion of your property towards a public realm space?
Not for the size and scale that I've been doing. No.
Yeah. Okay. No. That's really interesting. And I can guarantee you 99% of the people that are listening to this recording have not actually allocated some portion of their site for public realm. Like it just would not make any sense. So that's why there is what the city has done. And every city, by the way, throughout Ontario, they have done what is called a cash in lieu of parkland. So you probably have paid this extra fee like to the city right, for Parkland. Well, that's what they use to develop eventually parklands and maintain other type of public realm spaces, right? So on a sixplex, so now kind of bringing it back in, what is happening here is that, and I'll read this. It says the creation. So this is the exemption component of the municipal code. It says, so the creation of one additional residential unit as it exists. This is what exists today in an existing apartment building or structure containing 5 or more dwelling units, which exemptions for greater clarity shall be given once for the creation of only one additional dwelling unit on that lot. So today, well, I should say prior to July the 25th, you were allowed to only kind of waive one unit. So if you had a sixplex, a sevenplex, a eightplex, a 10plex, a 500 unit building, you're only allowed to basically waive one additional unit, which kind of sounds great if you were building at that time or in that era. Now today, fast forward to today, let's look at what it is was actually proposed. And I'll just read this out quickly, highlighted in yellow. So City Council.
So this is the DC unlock here.
So this is actually part of the DC unlock, but this is the Parkland unlock, right?
Okay, this is the Parkland unlock.
Yeah, because the Parkland, I believe Parkland is sort of equivalent to 1% of the property value, if I'm not mistaken. I mean, I'm sure you guys can drop a comment if you know the exact amount, if you have developed a property in the past there. That will be a fee that you will actually be billed by the city, but you'd only be waived for one unit. But that's if it were greater than 5 units, right?
And this is in relation to Parkland.
This is in relation to Parkland. So we're going to get to the good stuff, right?
Okay.
Yeah. Okay. We're going to get to the DCs, but this is very important because these Parkland fees add up, and this is what's going to help these projects to pencil.
Yeah.
Right?
Absolutely. Yeah.
So right now, what the city has done as of July the 24th, the City Council amend City of Toronto Municipal Code Chapter 415 Development of Land Article 3 to provide an exemption from Parkland dedication cash in lieu requirements for the second, all right? For the third, for the fourth, fifth, and sixth residential dwelling unit. Now, it does not, this is as good as it gets for our multiplex developers.
This is a nice win.
Yeah. So again, this here, as you can see, I do want to say that one of the things that is not mentioned here, though, is it doesn't mention very clearly if this includes detached structures like a laneway home or a garden suite. So here's where the nuance comes.
Interesting.
Right, so don't be surprised if you are doing a 4+1 or a 6+1, meaning a detached structure, and you get slapped with a Parkland fee bill by the city on that
detached dwelling.
The
ADU. Yeah, on the ADU. Yeah.
We don't know. It's not clearly stated in there, and you got to read the language for what it is. It's not mentioned. It's not included, right?
Right. Not in writing, doesn't exist.
Yeah, it doesn't exist, right? So this is a really important piece here.
You've been dropping goodies all day today. So what else do you have, Ron?
Yeah, awesome. So this is where things really get exciting here, and this is exciting for everyone. So there's lots of talk that's happening. So as of June the 25th, 2025. So this is a month ago. Right, so the city just adopted exemptions for the second, the third, the fourth unit, as well as the fifth unit in the form of a laneway or garden suite. So this was huge, but somehow they did not think through and say, well, we are now extending the pilot program within specific wards, and we're expanding the pilot program to include 6 units. So what happened to that group? So this was something that had to be retaught. And just as you say, Marcel, you're proud. You're proud of the city of Toronto. And what do we have here now? We now have essentially a new rule in place that is allowing exemptions on DCs on the 2nd, on the 3rd, the 4th, and now we're talking about the 5th and the 6th, right? As well as the laneway home, which is very clearly stated if you read through this document, chapter 415, article 1, you'll see that laneway homes and garden suites are exempted through the exemption program, the deferral program that they have, right? So, woo-hoo! Marcel, how does this make your projects work now today?
Look, this is why, people ask me why I've been sitting on my hands, and this is the importance of really having your eye on what's happening economically, what's happening based on policy, what's happening globally, what's happening financially, the flow of money. Like, if you're in this business, you need to have your finger on the pulse, just like if you were trading stocks on Bay Street or Wall Street, right? Like, if you're not in the game and you don't know what's going on, you're not making the same trade as someone else that does. So, staying close to this, we spoke about this earlier in earlier podcasts. We've been chatting about this. We geek out about this stuff a lot. When I'm talking to people like yourself and, other customers and clients, financing them. And, this is something that's been on the horizon. This is not just yesterday, right? This is something that's been on the horizon. And those that were patient and had projects that have unlock for this type of product, sat on their hands and waited. And now, this is a massive reward, right? This is a massive benefit to help your project move forward.
Well, lots of people are cheering right now. They're cheering on their mayor. They're cheering on their Mayor Chow, who actually supported, because there was a lot of disappointment when sixplexes were essentially reduced down to center of ice, right? Only 9 wards. Right, versus 25. There was a lot of disappointment.
Still waiting on South Scarborough. Hello. Wakey.
South Scarborough, that's right. There's lots to unlock there. And eventually it will happen. We talked about this briefly, but what is the federal government saying about the reduced approval? Because this was part of their action plan, their initiative. One of their initiatives
the question becomes is, will City of Toronto get the bag for this initiative? So it's almost like you went halfway, right?
Yeah.
Right?
No pun intended.
No pun intended, yeah. So this is good. Like, will the half unlock for this half or this partial approval, and progress here? Will it? That's something we should keep an eye on.
Yeah, absolutely, and we're definitely going to keep an eye on that. But I want to progress here and say, let's take a step back, because I want to also highlight there's also some really progressive councillors in addition to what we have seen the mayor done. So this whole DC unlock came to life by Jamal Myers, right? So shout out to Jamal Myers.
Shout out.
Ward 23, that's North Scarborough.
North Scarborough.
All right, shout out to you. If you guys are not connected with Jamal, definitely connect with him on LinkedIn or something. Just because, this is where this pilot all began, sixplexes. He's really been pushing the boundary here, and in fact understands what actually needs to be done. And as a part of that understanding, he put forward this motion, right? This motion to actually remove sixplexes, DCs, right? So essentially you can now build these sixplexes without having to pay DCs. It was seconded by Josh Matlow, and of course, it was amended to sound even better to small-scale developers by Mayor Olivia Chow. So again, we are starting to see a lot of support start to circulate this whole missing middle space. So this is exciting. This
This is
is
exciting news. Yeah,
really
So
exciting.
Mayor Chow basically got it over the line, um, and yeah, no, this is great progress. This is great progress. Yeah.
So one of the awesome things about this DCs is that, if you're a developer here in the city of Toronto, now you can essentially, save roughly around 250,000, depending on if you're a fourplex, sixplex. But there's also a real component here between if you're demolishing or replacing the entire building or doing a major retrofit, right? So this is really important. And I don't know if you have any thoughts on that, Marcel.
Yeah, and no, I mean this I can't stress the importance here, right? Like you got to make sure you're working with the right designer, we've got our 5-star Michelin designer here. But yeah, essentially, if you're doing that new unit, like if this becomes a new build, then you're going to have that 1 unit of DC charge that comes into effect. So this is kind of why from a feasibility standpoint, I like, retrofit. And if you can go that route of substantial renovation, that's going to be your it's going to be a great saving grace for you.
Oh, that's huge. I couldn't have said it better. Definitely, we certainly like sexy sixplexes, brand new from the ground up. But with that said, I think a lot of investors and homeowners would like to, keep a few $100,000 in their pocket. So we would always explore a major retrofit rather than a new build. Okay, so this here is just the vote panel. Like you can see here, all the folks that voted, and this was overwhelmingly successful. So the DC vote, the Parkland fee vote, as well as the permeable pavers, this was all wrapped into one huge motion with a few amendments. You can see amended item vote was adopted. So now this is the reality that we're living in as of July the 24th, 2025, right? The DC money bag. Like, what are we seeing here? And this is why there's been a lot of conversation around this. So a lot of industry stakeholders are basically questioning whether the city is making the most appropriate use of DCs. And is it even necessary to keep collecting DCs? So there's a huge conversation around what happens with that money. And as you can see here, from 2025, so I stripped this off ChatGPT. So thank you, AI, right? And essentially, you can see here, Marcel, there's been between 2020 and 2022, there is a bill, like essentially $100 million increase in DCs every year for those 3 years. And this was during the pandemic when there was a lot of activity. The market was strong. There was a lot of activity. And then between 2023 to 2025, you can see there's a 100,000 essentially $100 million decline in DCs. But remember, we're talking in the Bs, right? We're talking in the Bs here. This is billions. Have you seen any type of $1 billion infrastructure project happening in your community?
Yeah, I mean, where is all this money going is what you're asking,
Where is it going?
right? Yeah.
I,
Um, this is also, when I look at this data, this is also a good indication of activity as well. And so yeah, I'm looking at kind of the insights. You can kind of DCs are a real indicator, because like that's, as a developer, like that's one of the last checks you cut, right? It's a painful check, and like all your I's are dotted, all your T's are crossed, like you're moving forward, you got your financing, you've got everything in place, and when you're ready to cut that DC check, right? And that's a true indicator of a project moving forward. So like those numbers there, you can kind of, they tell a story about the market. You can see the slowdown now into 2025. It can also tell a story and drive your strategy, right? So you want to be, when I was selling in 2020, 2021, 2022, those that may not be around with us, and got a little too exuberant, are now, in trouble in 2024 and 2025. But this tells a real story as to where this will go. Will be interesting. We'll continue to follow that. I know on the larger scale projects, it's, there's delays that are being talked about from the recent bill, with DCs and all that kind of stuff. So this is a very important economic indicator, in real estate, and
Yeah.
we'll definitely continue to keep an eye on this and where it goes, right?
So I do agree with you on that comment. In fact, you're right. Bill 17, actually, which has reached royal assent, so provincial bill, reached royal assent. This was on June the 5th, and they're currently developing the regulations. So the provincial government is basically going to really encourage in a very deliberate way cities to remove a lot of their DCs, to defer more of their DCs, to remove interest collected on DCs, to freeze DCs and all this stuff. So this
Right.
is going to be through Bill 17. One of the interesting things is that Toronto, again, leading the way. They're just saying, look, we don't need you to ask us to freeze DCs. We can see from a $1.3 billion collection in 2022 to a reduction, essentially. This is almost about $500 million. They can see in 2025, right? That's the difference between 2022 and 2025. Almost $500 million in DCs not collected. And to your point, this is essentially showing that, look, we actually have less construction happening, right? So how do we boost that construction? Let's freeze this thing right now and let's remove it where we can. And let's also make sure the provincial government reimbursed us for what we have already deferred, and encourage them to keep doing so we can sort of offer more relief to developers. So this is huge move, big move. The money bag is shrinking, and but with the money bag shrinking, it's necessary for us to get builders building again, right?
Okay, let's turn to some more macroeconomic looks. Right now, we've got the CFIB foreseeing recessions in Canada, and that's within the economic contractions between Q2 and Q3. So, really, what the report shows is, this is a forecasted growth decline for the second quarter. And they're forecasting that it's going to decline again in the third quarter. So, when it comes to recessions, right? What we're talking about here, Ron, is a technical recession, right? The definition of a technical recession is 2 quarters of decline in the country's GDP. This is why we always follow GDP. We follow job growth, employment, income, that kind of thing when we're talking about real estate. And really what this is due to is, as this article kind of notes, is, the tariff concerns, right? They're obviously there. They continue to hinder us, and it's like a bit of a drag. And then you've got slower population growth as well. And this is really dampening kind of consumer confidence. So you can kind of see overall consumer confidence is down, as people continue to be concerned, they spend less. Trips outside are kind of canceled. Maybe you stay within the province or whatnot. So these are all things that are happening here. We looked at another source here. This is a survey from BMO, and you can see the sentiment. Right, the sentiment is growing. So like 74% of respondents said they were concerned about a recession in 2025, up from 60% a month earlier. So when you start to see articles like this, you kind of start to see what the sentiment is. And oftentimes recessions like this can be brought on by consumer sentiment. So they're almost self-induced, you know what I mean? In many respects. Now, the question to you is, Ron, like, are you seeing this? Are you feeling this personally? Are you seeing this with customers and clients kind of a little bit shy to move forward, kind of, really, double checking their numbers, like looking at financing options? What are you seeing with your customers that are coming through?
Yeah, I definitely am seeing a reduced appetite for for spending, but I would also say for investing. Like everyone
Yeah.
is really looking at numbers. Like, I would say we have to be very cost conscious and try to figure out how to support our clients with their budgets to ultimately still achieve a similar goal, which is helping us also as a business kind of tighten our processes and shave off the fat, which is
Yeah.
actually kind of an interesting thing. I will say that is this recession sort of under the disguise of companies retooling essentially into a more AI driven economy. People are losing their jobs because companies are getting rid of people and employing AI. And of course, through people losing their jobs, there's less spending. So it's like, is that a factor there, right?
Yeah, this so you've hit a nerve for me. I don't want to go off the deep end into
Yeah,
this.
yeah,
You know me and innovation and AI. I can speak forever on this, but
yeah.
but here's my view, right? So I think what will happen is at some point, in history, we'll look back, and despite what you feel about Trump, whether you like him, dislike him, you're gonna look back at this period and be like, okay, that person there pushed a nerve, and it really spurred on changes that were kind of deferred. I almost liken it to like a property with deferred maintenance,
Kind
right?
of,
You just
yeah,
keep pushing it off, pushing it
yeah,
off. Um, and I think, I'm no expert on his strategy. I just kind of reading his book on negotiations and all that kind of stuff. Like
yeah.
these are the kinds of things he likes to kind of stir up, right? He's like, he'll push that candy jar down onto the floor, it'll break, and then nobody gets candy, and then he'll negotiate for the candy, right? Like these are the kinds of strategies he uses. So so what's happened is, we've got this button pushed. The nerve has been pushed, and now, Canada, once again, very sleepy on, economic policy and what we're doing, and economic development, and really driving productivity and innovation, is waking up, right? You're seeing, this policies on the real estate side being pushed like never before. I've never seen this. Um, and the AI race is on, obviously.
Yeah.
These are things that are all going to kind of bring on this new wave, right, of this new economy that's coming, right? This kind of AI economy that's coming, and being driven, which will be primarily driven by productivity. And you're right, Ron. The job loss is very quiet right now, but it's happening,
Yeah.
right? It's happening at these big tech companies, and it's going to trickle down, and this is something that we're going to start to see. So I think what's not being said in the news, and this is kind of, the insight that you just brought to the surface, is there is this underlying concern with, like, what will happen to my job in 5 years,
Yeah.
right? I know I think about this, like,
Well,
especially us knowledge workers, right? We're both knowledge workers. We take information, we process it, and it comes out the other side. Obviously, there's a human relationship with what we do, so that will remain. But there is an underlying concern here, that's not being written in the news, and that's people in this kind of near to long term really concerned about their job. And I think that's something that, we should. I'm glad you brought that up, and that's something I put on the table with this potential recession that we have coming up here, right?
that's
So
right.
it's further self-induced, with that concern, right?
And I would
So
also add here that I am, and more and more people I'm starting to see always during a recession, we start to see more entrepreneurially minded people started popping up. And I've seen that myself. And I look back on my decision to start this business now, going on 9 years now. We're consistently growing. Yeah, I appreciate that support, bro. And you know what? The reality is that, the the whole idea of job security, right, was such a nerve-wracking thought to me when I was in that space. I
Yeah.
always felt like I had no control, and
Yeah.
I had no control to combat a recession or combat the ability to lose this job or position. With that said, now as an entrepreneur, as a business owner, I feel so much more comfortable and in control and have the ability to do so
Right.
to combat a recession. And I can innovate, I can, and so forth. AI certainly plays a role in that. So I recognize that we're in a tough time. Canada is in a technical recession, as you mentioned. People are not
Well, not just
buying.
yet. Not just yet. It's the forecasted.
Yeah.
It's
Okay, they're forecasting.
potentially coming.
Well,
Yeah. Yeah.
well, I've also
Not
seen
just yet.
forecasts where they're saying like we're certainly not going to see any sort of real economic rebound until spring of 2026.
2026. Yeah.
Yeah.
That is something we didn't
Yeah.
that news, but yeah, I've read that as well.
Yeah.
So yeah, we're in for a
Yeah.
bit of a long haul here. We'll jump into fixed mortgages and what's happening there with bond yields shortly, but yeah, just to end off that point, I think this is been my whole MO. This is the power of what a real estate cash flowing real estate portfolio or mortgage portfolio. I'll talk to you guys about that another time, but let's just focus on real estate. That's step one. Real estate portfolio cash flowing can do for your mental and your wealth generating and recession proof for your family, right? So it's like this tool that you can get in, you generate the cash flow, that in turn really helps you to weather the storm. Whether one or both of the dual income holders are kind of affected by the economy in whatever way, right? So this is the importance of and why I'm so passionate about especially newbies getting in, get that cash flowing real estate. You stay long term, a long term outlook. It'll really change the future. And multiplexes, great way to get started. Now you've got, think about this now. Think about this, Ron. Right? When I first started in this, there was no policy, there was no, DC waiver stuff. We hacked it, right? I was talking to one of my investors and clients earlier this week, right? We hacked it, right? We bought these properties, we sat on them, we renovated them. We treated our clients. We don't call our tenants, they're clients, right? We treat them very well. And they pay down our mortgage and the properties increase over a time period of time. And eventually, you don't have to do anything, right? Most of my clients in the past, they're not even buying anymore. They're done, right? they just sit there. They're on vacation and this stuff. So now we're just kind of renewing mortgages and trying to find the best rates and that kind of stuff. So that's where they're at. Great place to be. And the point being here is now you can go and buy a property. Think about this. Live in one of the units and rent out 6. And to make it even better, your takeout mortgage is there with a high loan to value via CMHC, right? So you're going to pull most of your capital out. The challenge will be for you is maybe renovating, coming up with the cash to renovate and build it. This is where we can help. We can help with the construction financing. We can help with that acquisition. The rest is maybe that equity raise, right?
Yeah.
We talk about joint ventures. We can talk about that another time. But these are the kind of things I teach, right? So this is the opportunity now with a little delayed gratification. You don't have to have your own single family home. You can now get into can you imagine the income you're generating from 5 units and you live in one? Like this is the unlock. This is what I talk about, that delayed gratification unlock. You get in small, when your mortgage payments are covered, right? And this was the biggest unlock for me. When I figured out how to cover my mortgage payments because someone else was paying them, that unlock for me freed me up. Now, when I went to quit my job, it was kind of like, nah, I wasn't concerned, right? I had that backing. So this is what we're talking about here. When we bring in this news, we're bringing this information, we're bringing this education. This is what we're talking about here. This is policy has caught up.
Wow.
It's never been like my investors. He almost fell off his chair because he's like in vacation somewhere in wherever in
Man,
in Europe,
this
and
is
he's
so
kind of
good.
like he's not really following this stuff anymore, and most of them don't, and he's kind of like, what? Like, you can do 6 units now, and there's no it was kind of like he almost fell off his chair, right? So this is the power. This is what we're talking about. This is the unlock. That's all I have to say about that.
This is great, man. You got
That's my mic drop.
You got me super excited there. And Marcel, we should definitely pull together a case study that properly documents what it is a design of a sixplex look like and the supporting financial performer that outlines what rents are, lease rates are, what resale rates are, as well as what DC overlays are, in this case zero, and really present that as an attachment.
Let's do that. Let's do that, Ron. That is easy peasy, lemon squeezy.
Yeah.
Done that. Do that every week.
Lemon
almost every day.
squeezy. That's what I'm talking about. I like my dishes shiny, right?
Let's talk about some fixed mortgages.
All right, awesome. Let's do it.
So fixed rate mortgages, rates creep higher as bond yields rise. So lenders have started raising fixed rates again. It's signs of this is kind of more of a shorter term upward trend, but that is starting to happen, and something to keep an eye on. So next slide. Fixed rate mortgages have been creeping upward over the past week, fueled by a modest rebound in bond yields. I'm going to explain the relation between bond yields and fixed rates in a very easy to understand way shortly. So just let's finish off what's happening here. So we've seen the rising U.S. Treasury yields, with the 5-year rising above 4%, following stronger than expected inflation data. So there's a bit of inflation concerns there, obviously, with what's happening. If we go down lower, we see on this side of the border, Canada's strong employment report added to the momentum. So this is interesting. We've got a stronger June employment report that's just kind of fueled a little bit of this momentum. But there's also some inflationary concerns here. So the bond yields are starting to rise, and in turn, the fixed rates rise. Now, before I explain the relation and how this works in very simple terms, because these are very important things to understand, Ron, what are you seeing here? What's any thoughts? Any comments?
Yeah, I'm really glad that you brought this up here, and I think it's really important. Like, I know there's a number of things that happen on the back end of movement of money, and I can see the U.S. Treasuries here, Treasury yields in general, which I know there's this very specific type of bonds that is looked at from a commercial standpoint. Could you kind of just break that down, if possible, Marcel, in a simplistic way?
Yeah.
Bond yields versus prime interest rates, and could you break that down for our listeners so they have an understanding?
Okay. So bond yields and fixed mortgage rates. Let's take, in a very simple way, let's take 1 minute and let me explain how this works. Okay. So here's it in plain language. So banks and lenders make money by lending you money through a mortgage, okay, at a higher rate than what they pay to borrow or invest, right? So it's kind of, there's some arbitrage there. So when a fixed mortgages, they're unlocking rates between the 1, 3, 5-year, and so on and so forth, right? Those are the most common. There's actually talk of unlocking more years and giving people more variability, and I think that you'll see that change coming soon. So they really want to be confident when they're lending at these 3 and 5-year terms that they're still going to make a profit, right? So they need to have a spread. So to figure out what to charge, what the lenders look at is the bond market. Typically, it's that 5-year government bond, right? specifically, and this is right, how much interest the government pays investors to hold over the same period of time. Okay. So if the 5-year bond yield goes up, that means lenders have to pay more money to borrow or invest. So the fixed rates mortgages go up. Okay. If bond yields drop, borrowing is cheaper, and therefore fixed rate mortgages can usually come down and be adjusted. So let's just say, for example, if the 5-year bond yield was 3.5, lenders might offer a 5-year fixed at like 5%. So they can earn a spread, which is about 100 to 150 basis points, right? If that dropped to say 3%, then the lenders will usually lower those fixed rates to say 4.5. So essentially, like what this chart shows is quite simply just the relationship between fixed mortgage rates following bond yields, right? So if bond yields go up, then usually fixed rates go up too, and vice versa. That is the simplest form in a nutshell of how this works. So here's some more mortgage news around fixed rates and borrowers facing up to 20% rate hikes. This is kind of a warning from the Bank of Canada, and really I wanted to break this down and into like a few discussion points within this article here. So the first thing that we see here is this renewal shock. Okay, so we see this renewal shock, right? So this slide represents about 1/3 of all mortgage holders will likely see payment increases by the end of 2026. So the first chart, and really what we're looking at is that 18.3% by the end of 25. That represents the payment increases, right? That we're going to see. So about 18.3, about a third, are going to see payment increases, and I'll talk about to which types of mortgages in a moment. The majority, no changes, and a small percentage, 10% decrease in payment. In 2026, the chart to your right, you'll see this is where it spikes up. So that's that 1/3, right? There's 33% of payment increases, and this is where the headline is. This is where the headline is kind of drawing some fear, right? So let's break that down a little bit and talk about really what's happening here. So there's a bit of renewal shock, right? Renewal shock is real. It's coming. Roughly about 60% of Canadian mortgages are scheduled to renew between 2025 and 2026. Okay, so banks estimate, according to the Bank of Canada, 60% of those will see higher monthly payments than what they paid in December 2024. Okay, so that's what they're estimating. Among fixed rate mortgages, particularly the 5-year fixed term, which accounts for about 40% of all outstanding mortgages of borrowers renewing in 2025, those are the ones that could see a payment increase between 15 and 20%. So what does that mean? That 15 to 20% jump, right? And this happened to me as well, right? Like I went to renew the other day, and that's like, that represents like a $2,500 mortgage payment. That 15 to 20% is like $375 to $500 more per month. So there's a silver lining here, right? While I'm not going to say like that's not a lot of money and don't worry about it, that could mean the difference for some people depending on what you're doing, but it is moderate, and the end result of what they're talking about is the landing is not going to be that hard, right? But $500, it's starting to get a little painful, right? Like every month, right? That in fairness, right? That could start to get a little painful. So that's one point. The second point, fixed versus variable. Not everyone is in the same boat. Okay, so borrowers with fixed rates, fixed payment mortgages are most vulnerable to the payment jump. Okay. In contrast, those with variable rates and variable payments may actually see monthly payment declines around 5 to 7%. Now, I want to pause on this. Variable rates historically are where you will typically do best. Okay. Historically, if you take a variable rate, historically that's going to be your better option. Okay. Now, most people can't stomach, the news and things going up and things going down and the roller coaster of it. So I always tell people, like, if you can't sleep at night, make sure you lock in some way, shape, or form, right? You don't want to be like playing that game of, not being able to sleep at night because, your variable rate mortgage may go up. Now, another thing, when you get that mortgage, that variable rate mortgage, right? This advice is gold. When I learned this way back, right? Like, 18 years ago, right? When you get that variable rate mortgage, especially if it's a rental and the times are good, you're paying the 1 point nothing, the 2 point nothing, even the threes now are looking really good, right? When you're paying that, pay that as if you're paying a higher rate. Pay that as if you're paying 200 beeps higher on that. So like if it's 3%, pay that as if you're paying a 5%. Okay. Especially for your rentals, especially for your principal, especially if cash flow prevails, right? Remember on these smaller rentals, right? These smaller multiplex rentals, 1 or 2 is not going to be retirement for you. These are long holds, right? You're not retiring on the cash flow for these. You want to tuck your cash flow away, and you want to, have it there for upgrades and continue to plow it back into the properties, right? This is not big enough cash flow to take out if you only have a couple and go on vacation and splurge it, right? You can do that once you get a few, but this is sound advice. So pay that as if you're paying a higher. The challenge that people are running into is the variable rate borrowers with the fixed payments face the broadest outcomes. So this is where you get into negative amortization. And what happens is, as these rates were going up, people were still paying the same amount. The bank's not going to contact you. Okay, they're going to contact you and move it. If you have the variable, right, it's up to you. Whether it goes down or it goes up, it's up to you. Okay, a lot of people don't know that, right? This is where you have a good mortgage broker. They can do that on your behalf, maybe remind you or whatnot. But this is what happens. So people continue to pay the same rate, and then your amortization grows, right? And then you get the letter in the mail, and the bank's like, "Hey, man, like, what are you doing here? Like, you got to make a larger payment. The rate's gone up. The amortization has reached it's reached far enough. So now you've got to make a lump sum, or we're not going to really renew this thing, right?" So this is where the concern is. This is what we saw. We saw that in 2024 kind of come to fruition, right? So this is kind of what I'm warning against here, right? So you want to make sure that you're doing that. You're keeping an eye on that, okay? So the third thing, principal repayment payoffs. So borrowers who originated or renewed before March 22 have largely outperformed their scheduled amortization. So 80% repaid more than they require. So they did that, right? More principal. So only about 5% who actually own more is where the trouble is going to be, okay? So fourth point, who is in the impact zone? It's once again, it's those that have that fixed rate mortgages. So you can see here the yellow, the mortgage payments with the greatest increases, right, are those fixed rate with a term of 5 years or more, right? You can see that, right? Those with the greatest mortgage payments with decreases are the fixed rates with less than 5 years, right? So that's the difference there. So can borrowers afford the jump? And this is kind of where, the soft landing, according to the Bank of Canada, they are saying that most borrowers will absorb the payment increases. And this is primarily due to the forecast that people are essentially, incomes are essentially expected to be higher. And we just saw before in June, we've got a good job report. So that's where a lot of this is coming from. Now, I think this is short term. I don't know how long term that news is going to be. I can't say I agree with that. What the Bank of Canada is saying from that perspective, and what I'm seeing, I think that data is perhaps a little old, and it's not representing what we're going to see coming forward in the future. So that is kind of basically the update here. Some strategies to mitigate this shock. You really want to be accelerating payments, making lump sum contributions. I've been coaching customers and clients on that. These are the things you want to be, when times are good, you want to be paying down that variable rate. If you've got a good variable rate still, start making a larger payment on that, pay that down. This is a time you want to be in touch with your mortgage professional, your financial advisors, and really make sure that, you've got that cash reserve, tucked away. You're watching your mortgages, and like this is a time for a portfolio review, a portfolio checkup. This is the time to get that oil change on your portfolio, where necessary, right? So that is my advice. That's all I got for today. That is the mortgage update. Hopes that helps. It was a bit of a mouthful, but Ron, please, if you've got any questions,
definitely. There's so much you said there. You got my mind turning, and I'm just thinking, like, man, like this is a lot of great insight and information. We're gonna have to chop this up into sound bites because, I mean, listen, I was a student in that session there, right? A lot of people don't really understand much about mortgages. But that's where, that's really like where it is your wealth is created, right? Like that's the thing, that principal pay down, the interest that you're paying there. And, it really, one of the things like I'm talking about, I'm very curious about is how do you help individuals that are doing, let's say, a major renovation or a larger scale or new build project? Like, are you encouraging them to do, for example, a variable mortgage on the front end, or a short-term term mortgage, like 1 year, 2 year, depending on the length of the project? Like, how are you structuring that for your clients?
Great question. Obviously, that's going to depend on, case by case, the customer and the project. For the most part, the best deals are going to be those that you're not going to be able to finance from a bank or a B lender, right? Just because they're uninhabitable.
Yeah.
Those are going to be your best deals, right? So those are going to be financed typically private. You're going to construct with private money. A lot of people don't know that, private money is what drives the majority of construction, right? In this business, especially at this scale. Most banks and credit unions will not finance construction. They say they finance construction, but good luck getting a construction loan, right? For these kinds of smaller deals, right? This missing middle stuff.
And that's why you got your mortgage money guy, all things lending, right?
That's why I've got your back. So this is what we're talking about. So if you can't, then it's private acquisition with a construction facility ready to go. Once you get those permits in hand, you're right into the ground, money's moving. And then once you're done, if you're flipping, you sell it obviously, but if you're not, highly advise you don't. You get that renter in there, and then you take it out, to whether it's 5 units or more, CMHC, or conventionally, if it's less than 5 units. So that is the model. That is the best strategy. The alternative would be maybe you finance, if you're going to finance with a bank or credit union, credit unions or B lenders, you're going to be B lenders specifically, high fees to break the mortgage. So you want to be 1 year, if that's your outcome and how long permits are going to take. Otherwise, you're into the banks, credit unions with a variable rate that you can break once you've got your permits. And then you're replacing that mortgage with a construction financing that's likely going to be private, could be credit union, depending on where you are.
Got you.
But now you're getting 2 mortgages, so you can see now where you may have double fees or whatnot. There's going to be some breakage depending on how long it takes to get your permits. So this is why I like the quick. Once again, I talk about this business. It's all about how fast can you get in, how fast can you get out, right? If you don't follow that formula, then the only person that makes money is who, Ron?
The lender, right?
The lender, right? So it's in and out. How fast can you do that? And that's a question of good analysis, right? Understanding a good analysis initially. Great design professionals, great consultants, builder partner, and execution, right? Build that thing, baby. Build, baby, build, right?
Awesome.
Get in and out quick. Hopefully that answers your question
That
there,
definitely
Ron.
does answer it, man. I know you got a depth of knowledge you can still bring to the table here. Maybe we should do a question answer on this topic, because lots of people are going to try to figure out. I mean, from a policy standpoint, there's a lot of unlock, but then how is that implemented in a real time, right?
Yeah.
So
that's the $1 million questions I'm getting daily, right? Like, okay, policy unlock, and now let's add another layer to that. Not to get into more discussion here, but imagine adding the layer of offsite to that, and speeding up, right? So now remember that in and out.
Yeah.
Now your in and out is
compressed,
shortened, compressed. Oh wow. Oh wow.
Yeah, that's amazing.
What a future. What a future.
What a future. What a future, man.
All right, Ron, that's all we got. Great session. Lots of information, lots of wins. A few things to be aware of. Mortgages can be stressful. Recessions can be stressful. A few things to be aware of. But these are all part and parcel of the market. Markets need a breather. We are seeing that right now. We're probably going to be into this breather into 2026, like Ron mentioned. We're going to keep an eye on it. You're going to have your source here, where we're going to keep it in simple, plain, easy to understand language. All things real estate news. Ron, take us home.
Awesome. Thank you very much, guys, for listening to this episode of Real Estate News Unpacked. I'm your co-host, Ronald, your 5-star Michelin multiplex designer, and I'm here with my co-host, Marcel Greaux, your mortgage money guy. We're happy to take any questions and answer any comments that you guys submit. But please remember to like and subscribe to this recording. It helps us to reach more people. But until then, we'll see you guys.
See you later.